Let's get some insights in the news shaping the markets. For that, we welcome in Kevin Mahn's here, President, Chief Investment Officer, Hennigan and Walsh Asset Management. Nice to see you. So we're on our 8th day of gains for the S&P 500. Pretty impressive. I don't know that anybody expected that just then. What are your thoughts?
Well, Nicole, they say that April showers bring May flowers, and we certainly had a lot of showers in April in terms of market volatility. But surprisingly enough, the NASDAQ finished higher for the month. The S&P was relatively flat. And now we're starting to see some buds of those May flowers. And I think if we hear a couple of things in the upcoming weeks, those things could be, one, an announcement of a couple big trade agreements with certain large countries or large trading blocks. Perhaps we'll get an indication from the Federal Reserve that that first rate cut of 2025 may come at the end of the second quarter after their June meeting. And of course, we're targeting July 4th for the extension of those tax cuts. The more and more likely that becomes, the more and more likely there's tailwinds behind this current run in equities. So I believe there are better days ahead, and we're well positioned for the second half. But buckle up, because there's going to be more short-term bouts of volatility, at least over the course of May.
Think the bottom is in?
I think the bottom may very well be in. Now, as I say that, I don't know what the next tweet is going to be. I don't know what the next announcement is going to be with respect to tariffs and trade. But I think the largest impact around tariffs is now going to be focused on China. The worst is behind us as it relates to those other countries. And companies are now starting to navigate around the certainties, at least what they know at this point in time, around tariffs. We heard that from GM earlier this morning as they announced that they don't intend to build more plants in the U.S., but they have 50 existing plants. May they will increase production at those plants to be more efficient and comply with this new world order as it relates to tariffs and trades. So companies are now repositioning, they're pivoting, and they're trying to build their profitability for the balance of this year, given what they know now.
So you're looking at different sectors,
yes.
For example, the utility sector. Where does that fit in now?
So utilities are a great way to play a volatile market. They're generally more defensive in nature. Most of them pay good dividends, and they've become a backdoor play into the AI revolution as it relates to power solutions. We continue to hear more and more from Microsoft, from Meta yesterday, from NVIDIA next month about the continuation of the spending as it relates to the AI revolution and AI infrastructure. But none of it can take place without power. And as it stands right now, the power solutions come from multi-utilities, whether it's with respect to electricity, natural gas, or even nuclear. So companies such as Duke Energy or DTE Energy are well positioned for that very outlook. They both have dividends around 3%, a beta of less than 0.5. The stocks are up around 14% year to date as well, and their PEs are relatively attractive around 19. So utilities seem to be a very attractive sector right now.
Understood. What else are you watching as far as, for example, technology? I mean, we got in Meta and Microsoft. We're waiting on Apple and Amazon later today. Do you like this group? Are you interested in the group yet? Are you buying dips?
I think the AI revolution is here to stay. I think what we learned from NVIDIA just a couple weeks back when they committed to an additional $500 billion in spending as it relates to AI infrastructure in the United States. I was in Phoenix, Arizona last week. I saw the TSM plant where a lot of that production will take place for NVIDIA. It is massive, and it's only going to expand further. So I believe we'll continue to hear more and more announcements coming out of this earnings system that spending will increase, and the AI revolution is in fact alive and well.
All right, so at this point now, end of the year, I mean, not on December 31st, but do you think the back half of the year or that November will be higher than where we are today?
Yeah, and I just look at history as a guide. And I know past performance isn't indicative of future results, of course. But through the first 73 trading days of this year, the market was down 10.2%. The fifth worst start on record. However, here's the good news. Those 4 previous worst start, from day 74 through the end of the year, the market was higher by an average of nearly 24%, and higher in all 4 cases by double-digit returns. So yes, if history can serve as a guide, we could have a pretty strong close to 2025.
So you mentioned utilities. I mean, you watching these tech names, and I guess you like them for the long term.
Certainly.
What about other things? Gold, Bitcoin, people have been looking to those.
Yeah, away from gold and Bitcoin, other areas that have resonated thus far this year include international stocks and value-oriented stocks. In fact, international stocks from the developed market side have outperformed U.S. by over 16% year to date. Yet most of Wall Street is under-allocated to international. So maybe now is the time to actually diversify your portfolio globally. Look for those value-oriented international stocks that also pay good dividends, such as a defense manufacturer in Europe called BAE System. A good way to play that rise in defense spending, get some value in your portfolio and some international exposure as well.
I mean, there's so many ifs. I mean, you talk about trade agreements and getting the tax cuts pushed through finally for good.
Yes.
Right, because they've been extended is really what has happened. And if the Fed cuts, how, the trade agreements, I'll start with that. I mean, it's actually been acknowledged now by China that somewhere there was some media reporting that she spoke with Trump. What do we need to see there to make us feel better at home? Because the concern here is that we're going to face inflation, we'll have supply chain issues, et cetera.
I think we need an announcement of a large trade agreement. China is going to take months, if not quarters or years, to renegotiate or negotiate further. But if we see something coming out of the European Union, if we see something coming out of India or Japan, I think that will give investors some form of reprise that there is an end goal here, and it could be for the betterment of the U.S. economy.
Right.
But I also think, Nicole, that the Fed put is now in. We saw the U.S. GDP contract in the first quarter.
Right.
We've seen disappointing reports on the jobs front this week.
That's a preliminary number.
Those are preliminary numbers, of course, but the
GDP,
economy is slowing, the job market is weakening, the Fed may step in with a 25 basis point cut after their June meeting, and that would be received well by investors.
I mean, we're getting in some data. We're not seeing as many job openings. We're seeing more claims. What do you think about tomorrow's labor picture?
I think it's going to be more of the same on that front. Another concerning report as it relates to the job markets. Keep in mind that the Fed raised their forecast for unemployment this year to 4.4%. They think it only comes down to 4.3% next year. Not alarming rates, but higher than where we are right now. So the Fed is already modeling that in, which is why they're staying with their forecast for 2 rate cuts this year. And I still contend we may get the first one during the first half this year.
All right, Kevin Mahn, great to see you
as
at
well,
Hennigan and Walsh Asset Management. Thank you for being here today in person.